here is Ticky Fullerton on Your Money.
Hello there, I'm Ticky Fullerton, every night bringing you a full hour of the very best in business coverage across the nation and internationally, especially where business and politics meet. Well, a big day coming up. AMP, a matter of priority. Shares back up 7% today, with a board firmly defending the insurance sale and rumours that Macquarie Bank is cooking up a bid. Well, we'll talk to the man driving AMP strategy for shareholders, Chairman David Murray. National Australia Bank reports a huge and challenging year. NAB Chief Executive Andrew Thorburn tells our Chief Business reporter Leo Shanahan. That interview just ahead. And three of the country's best-placed property and development experts talk to me about the perfect storm that's here for developers and the big issues for the nation and for the markets going forward. Chief Commissioner for Greater Sydney, Lucy Turnbull, Stockland's Commercial Property CEO, Louise Mason, and Lend-Lease's Property Australia Chief Kylie Ramper, all to come. Now then, two of the big banks reporting this week are a window into both the softening of the housing cycle and the pain of the Royal Commission. But it's the fate of another great old Australian which hangs in the balance, the 169-year-old grand old AMP. And that fate is to a large extent in the hands of its board and particularly its chairman, David Murray. Well, today, Joyce Malarkis revealed in The Australian that the fifth pillar, Macquarie Bank, reporting annual results tomorrow, has been sliding the rule over AMP with a view to perhaps making a tilt. It's a big story if it happens. It helped lift AMP shares 8% today. This rule sliding by Macbank has apparently been going on for some time. Indeed, it seems that Macbank and UBS had been jointly advising AMP on what to do with its life insurance business when the old millionaire's factory quietly removed itself from that role, fueling speculation that there might be a small conflict of interest over its own intentions towards AMP. Then, late last week, came the move by AMP, which made a Macquarie bid possibly all the more attractive. AMP announced the $3.3 billion sale of its life insurance business, the business launched to help Australians over a century ago. Now, nostalgia aside, it was still a controversial deal, met initially with dismay by the market. AMP shares, which had been on the slide, then plummeted, I think, about 25%, its biggest one-day drop ever on the stock exchange's correction day. The sale to British Resolution was a shock in terms of the value it delivered, and the payment was part preference shares and shares in Resolution, which would take time to monetise for shareholders. Well, by the weekend, some furious investors, including Merlin Capital and Alan Gray, were burning the midnight oil to produce an excoriating letter which accused the board of value destruction, burning about $700 million worth in franking credit value, and called for an EGM to perhaps spill the board.
Some fund managers would say this is going to do more damage. We don't believe it will, because this has got nothing to do with the customers, and in our view, nothing to do with the Royal Commission. This just has to do with the directors selling the business at a very poor price, and the disclosure wasn't good around that. And the question now is, can we get out of the deal, number one? And number two, if we can't, can we at least have the money back?
Well, look, then yesterday, AMP, I think acknowledging it could have handled things around the sale a bit better PR-wise, moved to assure investors that the strategy was sound in the face of growing headwinds in the life insurance business, where AMP lacked global scale. Now, that hasn't fully satisfied Merlin Capital, which sent another missive to the board today. Despite objections, though, the sale does look inevitable. But back to Macquarie's ambitions, the sale leaves AMP with a suite of assets which perhaps better fit with the bank's own business, and it's more manageable size now to swallow following the sale, when it happens, of the life insurance business, including AMP Capital with its infrastructure, asset management, the investment platform and a mortgage business. Well, if, and it's an if, this data room story has legs, then the ball may well be in David Murray's court. Now, when David Murray took on the chair of AMP, it was then, and it remains, the hardest turnaround job in the country. And he's right in the middle of it. With sleeves rolled up, he's called out corporate governance failings, which have muddied the waters on accountability between boards and management, which helped create many of the woes highlighted in the Royal Commission. These comments split the business community, actually. But Kenneth Haynes' final report in February could also threaten a lot more of AMP value, indeed a core part of its business model. The question for shareholders and Mr Murray is, if there is a bid lobbed in by AMP, would it make sense to accept it? More broadly, for financial markets, would it make sense to accept it? Look, David Murray is unmatched in Australia in his experience in the financial system. He's chaired the Financial Systems Inquiry. Before that, as Chief Executive of the Commonwealth Bank, he was the father of vertical integration, pioneering the expansion of the big banks into businesses beyond traditional home lending and personal savings and loans, both to soften bank exposure to the punishing property cycle and offer a broad range of financial services for Australians. Now, ironically, as we head to a softening of the property market, so too we're returning the big four banks to once more be exposed to the property cycle. This is a different era in which David Murray is making decisions. Well, here we are. That hopefully has brought people up to date. I'm very pleased to welcome the man himself, David Murray, AMP Chairman, who joins me live now in the studio. David, thank you so much for listening to that. And,
thank you.
Now, the market is up. I've got to ask you first about all this talk of a possible Macquarie Bank bid. What's your response to that?
Well, I'm sorry to disappoint, but I just not able to comment on that sort of speculation, unfortunately.
Yeah, I mean, it would seem, though, that Macquarie Chief Executive, Shamara Wickramanayake, is supposed to have had some quite heavy involvement in it. I mean, and they did remove themselves, did they not, as advisors to the sale of the insurance business?
Well, again, I don't want to disappoint. There's a lot of interesting things to talk about, but
yes.
I just can't comment on that.
Can I ask you a hypothetical one, David? If a bid like that was lobbed in, what would AMP's defensive strategy be?
The board of AMP, in every circumstance, will look to the interests of its shareholders.
Okay, all right. I mean, they have had an earlier look at this, haven't they, with KKR just over a year ago? So they're not sort of.
Well, I wasn't there at the time.
No,
so
you're the man.
I don't know.
Yes, you are the man now. So, I mean, but having sold, or you will have sold the insurance business, I mean, it does seem more of a fit. I mean, standing up there in financial services as you did when you did the Financial Systems Inquiry, and given all the sort of headwinds that, goodness me, the final report from Kenneth Hayne might deliver for you and others, wouldn't it be an option?
Well, what we've said is absolutely true. The complexity that this takes out of AMP is very substantial.
The insurance business.
Yes.
Sale, yeah.
To decouple that from the rest of the businesses makes life much simpler for us to design in the future.
Right.
And to the extent that anybody might be interested in AMP, at the time when we announced the sale of this, wouldn't it also suggest that we're doing the right thing? But I can't comment on any speculation. I'm just not able to. What?
Because you're changing it into a better business, a more attractive business for whoever ends up running it. That's what you're saying.
Yes. Well, let me just reiterate a couple of points about the life business. Using our numbers from the first half reporting, a $28 million decline in experience. Decline from experiences creates a $90 million requirement for additional capital and deducts $200 million from embedded value. That is not the sign of a business trending in the right direction. And during that year on year, up until December 2017, year on year up to June 18, the decline in that business, after allowing for reinsurance costs to further protect it, was still substantial. It's difficult for me to understand how any sophisticated investor could not take a reading from that trend and believe that the board had to do something about it. Well,
look, one of those sophisticated investors, Merlin Capital, you've been having this ding-dong exchange of letters with them. Now, they've sent another letter in today, following your clarification, AMP's clarification yesterday, and they say, look, AMP, yes, now confirms its view, Merlin's view, that the original valuation of 0.82 times embedded value was, quote, disingenuous and highly misleading. They see the deal being stuck on a multiple of 0.6 times embedded value, 6.5 times historic earnings.
We just disagree. That's all I can say. We disagree. And we have invited Merlin Capital to come and talk to us about this, and so far we've heard nothing back.
Right.
Yet
you did that this afternoon, did you?
No, we did it when we got the first letter.
Right.
But to keep sending letters to us and the media at the same time is highly unusual. Yeah. But we act in the interest of all shareholders. Individual shareholders, including institutional shareholders, will have their own motives, their own shape of portfolio, their own objectives in investing. We can't speak for each of those.
Yes.
And if investors are sufficiently concerned about the trend in a business or the way it's managed, their other alternative is to sell their stock.
They say they're a bit upset about the way that AMP attempted to discredit their work.
Well, I don't believe we've attempted to discredit their work. We simply, when we look at their analysis, we believe there are some misunderstandings about our business. I don't think that's a very defamatory statement. It's a very moderate statement. So
presumably you think basically this deal will now go through. Does it have many regulatory hoops to go through to get it through, like the ASX or anything like that? No,
mostly of a regulatory nature. Nature.
Yes.
And that's pretty much it. So,
so that's the ASX, or is it that? It's not
the regulators here in New Zealand, I believe.
Right.
And one would expect that would be okay, but apart from that, no.
Yeah. And David, you said that this decision was done. You and Mike Wilkins obviously have spent many hours making this decision. This decision was done not because of the Royal Commission, but really for prudential reasons.
For value reasons.
Yes, for value reasons. Sorry. Yeah.
Bear in mind, I think this is the fourth sale of a significant life business in Australia in recent times. One has to question why all of those owners felt the need to divest. And the reasons are these, that a cost of capital in Australia, given the regulatory requirements for life businesses, is uncompetitive in global terms. And once people with lower costs of capital bought into some of these businesses, it became even harder to compete. So the marginal return is utterly unattractive.
So just, I mean, how serious are these regulatory hurdles? I mean, what about, say, that IFRS 17 thing?
Oh, well, that's slightly separate. The capital, of course, is key. If you can't compete on cost of capital, it's very hard to stay in business. In any business.
And that's where scale is important.
Both scale, diversification of risk, and so on. The other complication, take IFRS 17. What we're being told is this: assume that the oldest policyholder at AMP is now 90, and assume that the policy was written when they were 20, 70 years ago, 1948. I don't know whether it was written with quill and ink or a Remington typewriter, how the data was stored, but the data that was stored was the data required to maintain that policy in those times, bearing in mind, amongst other things, definitions in medical science, if it's a life policy, applicable to that time. We fast forward to now, the world's accountants are saying to us, we don't care about any of that, we just want you to have different data. So the costs of adapting just to IFRS 17 in a business that's already in decline isn't good enough.
So your vision, once this is sold, your vision for AMP for shareholders now?
Well, AMP will still have a decent banking business, a decent capital management business, and a product and advice business that is needed by Australians. And the job from here is to restore the value of that brand in the mind of the customers, fix the business, and benefit from what will be a competitive business in an environment where many others have left, and that should put us in good shape.
You've still got to get through Kenneth Haynes' final report.
Yep.
Now, his interim report appeared to raise a whole lot of questions,
Yep.
including questions to which, if the answer was on the downside for you guys, I mean, it could really blow up significant parts of AMP, things like your platform business.
Yeah, we may have to, as others we may have to adapt significantly. But when I look at the interim report, those basic principles that the Commissioner has put down, to me, are very, very sensible. His suggestion about simplification of the law is, to my mind, is very welcome.
Yes.
His suggestion that once in place the regulators have to enforce better is fantastic, and of course industry, if they want to maintain their reputation, has got to comply better. But those things are positive to me. But then you have to combine that with one of the requirements of any recommendation that he's required to make.
Yes.
And that is that it's in the interests of users of the financial system. Now, one thing that will not be in the interests of users is that there's no affordable advice in Australia, when for financial advice,
Yeah.
know-how and proper treatment of the client is fundamental. But if they can't afford it, where do they go?
You touched on something really important, which was the brand and the confidence in AMP. I mean, clearly the last results have shown this massive outflow at the moment going on. I mean, how long do you think you're going to be able to keep going if those outflows continue? Presumably this is a big challenge for your new CEO, Mr. DeFerraro.
Well, yes, and from my background, I know intimately the importance of a brand and perceptions around a brand. Once that happens, you've got to get on the repair job as fast as you can and build confidence inch by inch with people. You can't just bluster your way out of it, you've got to rebuild. That's why the new chief executive that we've appointed is a confirmed change agent, and just the sort of person we need, particularly with deep skills in wealth management. And we're really looking forward to him getting started on the 1st of December.
Yeah, but if you get a bid before then, I mean, for some or part of the business, I presume the board will consider that on its merits.
We'll just sit down, whatever happens, could be that, could be anything else, we will sit down and apply ourselves according to our fiduciary duty in the interest of all of our shareholders.
Okay. Finally, can I ask you to reflect on a comment that I made right at the start, which is that this bizarre situation where, you know, there you were at CBA looking to presumably buffer the bank when it was only very exposed to the housing cycle by developing this vertical integration. Now we've come full circle, and we're now, our 4 banks, our simpler, better banks, quite exposed to the housing market, when presumably we're just about to come off. What do you make of that?
Yeah, well, I think there were 2 things that I had in my mind at the time. One was that if we have a significant retail banking business, we had to make sure that that was the most efficient, because computing introduced scale economies to that which had never been present in the past. So that was the first important thing to do. But with that computing came a distancing from the client, because a lot of banking turned into self-service banking, whether it be on the internet or at ATMs or at shops with credit and debit cards. So the question then was, how do we add value to clients in this new environment?
Yes. And
with superannuation emerging, with more of their wealth held in housing, with investor housing starting to grow, clearly people needed more, and it was from that perspective, and the fact that the superannuation system would grow in size relative to the banking system, that I believed at the time that.
But now you're sitting in AMP, which potentially is another vehicle to do just that.
Well, it's a vehicle to do just that. It's more intimately involved with their history, and it's as you say, the Royal Commission means a lot, but we have an opportunity to dig in, invest in and grow this business when others are retreating.
Finally, you're confident you can get through and out the other side of the Royal Commission?
things happen and people do recover if you've got the right change agent and the right people and a good board with their mind on it. That's all we can do. You recall in history when the US regulator just turned up one day and said that the Bell telephone company has to be divided up across the nation, and people survive, but we'll do better than survive.
David Murray, extremely good to talk to you. Thank you very much for coming in.
Thank you.
After the break, diving deep into NAB's full-year results with CEO Andrew Thorburn next.
You're watching Ticky on Your Money. Now, back to Ticky.
Yes, welcome back. Well, bank number 2 this week, National Australia Bank's full-year results and profit falling 14% as the lender grapples with the costs of compensating customers and a series of compliance failures. Cash earnings came in at $5.7 billion, down from the record $6.64 billion profit for the same period last year. However, the result was only slightly below analyst expectations as the lender warned ahead of the results it would book an additional $360 million in costs connected with the restructuring and remediation to customers. Like its rivals, NAB is suffering from the fallout of the Royal Commission into Misconduct, which is raising compliance costs. Company reporting expenses surging 18%. And Your Money chief business reporter Leo Shanahan sat down with CEO Andrew Thorburn at one of the bank branches in Sydney just a short time ago.
Andrew Thorburn, thanks so much for joining us.
Hi there, Leo.
Now, you obviously are down, but the market's rewarding you today. You're up over just 1%. I'm going to talk to these provisions firstly regarding the Royal Commission. The bank has booked a $435 million pre-tax charge to pay back customers for fees for no service and other associated regulatory charges. Is this it, or is there another scandal around the corner?
Well, I think the main point that I'd make, Leo, is that if we have charged customers for services that we haven't provided, we need to pay that money back. Yeah. And so what we've done is our best estimate as we know now, and therefore we've made the provision that we think is most likely. Now we'll continue to work through it. If it changes, we would do another update. But I do hope that most of these are wealth related, and so that we can get through those, and we'll see what happens from there. But what we're trying to do is fix these issues, make the bank simpler and change it so that these sort of things don't happen in the future.
Does that include a possible fine in the case brought by ASIC over fees for no service? Some are estimating that at over $100 million.
No, these are. I don't think so. These are mainly, firstly, the cost to actually do it. That's over $100 million. That's an expense number, and then the refund to customers, mainly in the wealth-related space. Right. So things like ASF and PSF, as you mentioned. So this doesn't
include possible ASIC fines?
No.
No. Okay. Costs aside, what is the worst-case scenario for NAB in terms of fallout from the Royal Commission? Are you, for example, preparing for criminal charges against certain individuals?
Well, look, I think it's been a tough year in many respects, not just because of reputation issues, because of the economy and the housing market and competitive pressure. And of course, inside the bank, we're doing a lot to transform the organisation. So it's certainly been a huge year. But I think we're doing the right things, Leo. I think we're making the bank simpler. We're investing. We're reducing the number of products to improve simplification. We're improving IT systems. We're investing $1.5 billion more over 18, 19, 20 on top of our normal investment spend, and that's to make the bank simpler and faster and to get in behind growth areas like the business bank. So, look, some of these things we can't control. If we find out new issues, we're going to have to face into them. But we've also got to keep trying to transform and change the bank for the better to build a sustainable business for the long term.
Now, we saw Andrew Haggar, a very senior former NAB banker, step down recently. What was your discussion with him prior to his resignation, and did you encourage him to leave the bank?
Well, look, this is a conversation that Andrew and I had over some months, and one of the things that happened was that his job was materially impacted because we decided that we would divest the MLC business. A lot of those responsibilities were part of his job. We split it. I appointed Jeff Lloyd to come and run that business so we can divest it. And I think as a result of that, and he's been in the bank 10 years, I felt it was time to go. And I really wish him well in his future endeavours.
Now, it's been a hugely challenging year for you at the bank, as you've said. We've had the Royal Commission, we've had tighter margins for the banks, we've had job cuts, even a criminal investigation into your former Chief of Staff. Have you yourself considered resigning?
No, I mean, I've been CEO of the bank for 4 years, and before that I was CEO of BNZ, so it's 10 years. But look, I love banking. I love, we're down here in the branch and you talk to bankers who are helping clients. And we make a huge difference to Australia. We're growing through our business bank, we're helping businesses start and grow. And in that sense, it's important to have a leader who believes in what we're doing, and I do. And I think we've got the right plan. And leadership's a challenge, and you've got to be constantly pushing into challenging the status quo, and you've got to have a great deal of resilience, but you've got to believe in what you're doing and what the cause is, and the team I work with are excellent. So, no, I believe in the journey, and I really want to help NAB get through this and become, an organisation and a bank that's respected by customers and the community at large.
Now, at results this time last year, we were talking about massive cost-cutting drive at the bank, over $1 billion and about 6,000 jobs. How's that progressing?
Well, yes, we are, Leo. I think what we've done over this last year, notwithstanding the backdrop of the environment you've referred to, huge changes inside the bank.
Also a lot of new investment as well.
A lot of new investment into technology, digital capability, simplifying structures, a new business bank model for small and medium business, professional services specialisation that we've set up. So I think it's been a huge year, and we have reduced the number of staff in the sort of core bank as we've automated services, and we've hired new coders and architects and data scientists and digital experts at the same time. So I think given all that juggling, it's been a pretty credible underlying result for the year for the bank.
Now, you've taken a very laudable step, some would say, in not following the majors and lifting interest rates. But how locked into that decision now are you, given the publicity surrounding it?
Well, Leo, your broader point earlier, it's been an extraordinary year. And if bankers aren't standing back now and saying, look, we need to think about some things differently and we need to change, I don't think we'll ever have that. We'll never do it. And I think I've really reflected on that. And some of the decisions we've made to not close branches, to not charge default interest, and to hold our standard variable rate for now. And really what we're saying to our existing customers, look, we appreciate your business. We want to earn your loyalty and trust, because to me, building a long-term business, you've got to have customers at the centre of it. And they trust you and you're a partner with them. And I think we've drifted a long way from that. And when you just keep putting rates up one after the other, I don't think that helps that trust that we're there for them. And so this message is to our existing clients to say we appreciate your business and rates are on hold for now. But we're not immune, obviously, to the funding cost pressure that other banks face. On a related question, obviously there's been massive downturns in the Sydney and Melbourne property markets. How exposed is the bank in terms of arrears loans and people moving to interest and principal in a softening housing market? Well, I think it's a good observation, because the house price market in Sydney and Melbourne is falling. It's going down 5 to 10% is our best estimate at the moment. But a couple of years ago, we took the steps to make 150 policy changes to really bring in a lot more detail around expenditure verification. We require customers to be able to pay 7.25% as their interest rate, to be able to pay back principal as well as interest, and then still have a buffer. So I think we're being, appropriately conservative. Our housing arrears have only just gone up a wee bit. They're not rising dramatically. We've got extra provisions we've set aside. So I think the bank can work through this. But what we don't want to do is step back from helping clients who do have sufficient deposit and sufficient financial wherewithal to buy a house or buy a bigger house. I think that's what we want to do. If they can afford it, we're confident in that. We want to help them do that.
Yesterday we had ANZ's Shane Elliott saying that he thought home loan growth would slow to roughly half to an all-time low as a combination of the Royal Commission and conditions. Interest rates aren't getting any lower. Do you agree with him?
Well, I think if you look at 4 or 5% now in housing credit, that means it could get to, say, 2 or 3. That's probably possible. But, where you've got nominal GDP at 5% and you've still got unemployment at 5%, you know, I still think that's an okay number.
Now, you may have been a bit jealous yesterday on the news of CBA selling its CFS GAM wealth management operation for $4.1 billion to Mitsubishi. You're obviously trying to sell MLC. How's that progressing, and do you have a buyer?
Well, we certainly are mobilised around the project, Leo. We said at the half we feel we should divest the business to make the bank simpler. We're not stepping away from wealth because JB Weir and NAB Trade are our sort of wealth offerings, but we feel divesting MLC is the right thing. We've hired Jeff Lloyd, ex-Perpetual CEO, to lead that divestment, and we've got good investment banks and a good team leading it. We're open to all options here: a trade sale, a straight demerger, or an IPO. We've said we think it'll be in 2019 calendar year, and we also said that Jeff would give an update to the market prior to our next half-year results. So look, I think we're moving forward with it, but when we've got all options on the table as we sit here today.
So you don't have a buyer yet, is what you're saying? No, okay. And finally, this time next year, will we be speaking to Andrew Thorburn, or will it be Mike Baird in charge, or somebody else?
Yeah, well, look, I love what I do, Leo. I believe the bank's purpose and vision is the right purpose and vision. The team I work with are good. We're underway in a transformation, and I've been in banking for over 30 years, and I believe in it more now than I ever did, notwithstanding what's happened. And I certainly going to take a good break at the end of the year, but I'm looking forward to the year ahead.
Andrew Thorburn, thanks so much for joining us.
Thanks, Leo.
Cheeky fellow, isn't he, our Leo Shanahan? After the break, how will Australian cities handle the massive spike in population in the next decade? Discussing urban development with some of Australia's top property and business people next.
This is Ticky on Your Money, covering the big business stories.
By 2030, 5 million additional people will live in Australia. With immigration levels on the rise and people living longer, the growth and ageing of Australia's population will have a big impact on the sustainability of our nation and how we house people in the future. So how will our cities cope? Well, I spoke with a panel of experts at the annual Australia-Israel Chamber of Commerce property lunch, namely Lucy Turnbull, the Chief Commissioner of Greater Sydney, just back from New York, Louise Mason, CEO of Commercial Property and Stockland, Kylie Ramper, CEO of, at Stockland, and Kylie Ramper, CEO of Lendlease's property business.
It's really sector by sector. If you look at logistics, it's still incredibly tight and it's still incredibly hard to buy. And that also relates to last mile logistics and the demand there. So that's still very hot. Residential that we're in at Stockland varies market by market. Still massive growth in the north and west in Melbourne, and we're still selling very, very well there.
Because you build whole suburbs, don't you?
We do, whole communities. Southeast Queensland still very strong, and parts of Sydney. So there's a moderation, but coming off an incredible high. Commercial property, lowest vacancy rates in Sydney and Melbourne that we've seen for decades. So it varies a lot, and retail is in a state of change. So it's really sector by sector.
Kylie?
Yeah, look, I'd agree with that. I think it's very, it's dangerous to generalise, but equally there are cycles. We believe in cycles, and cycles, ironically, I think are good. It creates great discipline within businesses. It also provides opportunities through the cycle. So we are, I think, at the residential where we're through the top of the cycle. But it does vary market to market. But there's definitely headwinds. There's headwinds around, you know, the Royal Commission and the impact on the credit markets, the increase in taxes to foreigners on stamp duty and land tax. We're shifting from interest-only loans to interest and principal. All of these factors add up to be headwinds into the sector. You know, but there's still other strong growth drivers, but it does vary market to market, and it depends where you're positioned within that market as well. So hard to generalise, but there's definitely headwinds, and you know, we are through the peak of the cycle.
Where do you see growth?
In the residential markets?
In any
markets. Well, there's still demand, as Louise said. You know, you're getting strong income growth in the office markets at the moment, so that's very attractive.
Well, I was just reading that Frank Gelber piece in the Oz from BAS Oxford Economics, and he was just talking about really it is on an absolute tear. Rents are through the roof, but this is a cycle. So how do you approach, how much further do you think that market has got to run from a landlord point of view?
And, you know, it does depend. You know, the Sydney market, there's the supply demand fundamentals are strong. Other markets where there's the potential for new supply to enter those markets can change those markets very quickly. Australian office markets have a very high correlation to US equity markets as well. Depends what happens on interest rates. Increases in interest rates will absolutely impact all property cycles. So I caveat our comments subject to what happens in those markets.
Back to you, Louise. Do you agree with that?
I do, but it's interesting too. You look at the Sydney and Melbourne markets where we might have been concerned 3, 4, 5 years ago about downsizing of law firms, downsizing of investment banks, but it's been replaced by massive growth in the tech sector. So when you have tenants come along that are looking for 30, 40, 50,000 square metres in a CBD, that's very different again. So there's very different sectors starting to come into the office market. And
do you think the change to increased or lower unemployment has actually really made a difference to the rental market on the commercial side, office side?
It has.
And I think coupled with that, Louise is right, you know, as certain sectors reduce their occupancy requirements, new entrants have stepped in, which is fueling that demand for office.
How long do you think this sort of tension is going to go on for?
I think, you know, we can't forecast out for too long, but there's no signs at this point of that changing in the office markets with the supply-demand fundamentals, the rental growth fundamentals, and then the demand by corporate tenants. I mean, there was some, you know, we all talked many years ago about the end of the office sector because everyone's going to be working from home.
That didn't happen, did it?
We've seen an absolute opposite impact where your location to a corporate is so important for the culture that you're trying to prescribe, and the value of the precinct and the place people work in is very important in corporates attracting talent and retaining talent. So they want to be in offices, they want to be in precincts that offer opportunities from a lifestyle, work style point of view from their people.
So, Lucy, let me bring you in here. You're trying to build a third city.
Three cities.
Yeah, 3 cities. How do you see the way the market is heading? This incredible sort of power, really, within the commercial market, but also a much softer market looking forward, perhaps on the retail residential side. When you look to plan.
Yeah. Okay. So what we do is we're not property market experts. We respond to population forecasts we're given and our...
Ask you about those.
Yeah. But our core mantra is to make sure that we plan for a well-distributed set of education facilities, health facilities, opportunities and jobs right across Greater Sydney. And what we're trying to do is rebalance, if you like, that disparity in connectivity and opportunity between the Eastern Harbour, which I like to call, for some people quite provocatively, I think the edge city, which runs up to the eastern side of Olympic Park, and then the central city, which basically runs from Olympic Park to the M7, and then the western parkland city beyond that. So we have to create greater connectivity within and across those 3 cities to make sure that we have a livable, prosperous and sustainable city going forward. And we can't just concentrate everything in one part of the city. But I think what's fantastic to see now, and as I said, I'm not an expert on the property cycle. I do read the newspaper, however, but what is fantastic to see now, very close to where we are, is this incredible transformation and rebirth around Circular Quay. And that is, to me, nothing short of inspirational, because that's, as a little girl, that's the first part of the city I saw change when the AMP building went up. And that used to be a real treat in the early 60s, going up there to see, you know, the tallest building in Sydney and seeing the harbour from there, and all that site's being, you know, rebirthed. And you know, a lot of the people in this room, Lend-Lease, lots of other companies are involved in doing really big new buildings there. And I think it's really exciting to see that transformation. But that transformation's happening around so many different parts of Sydney. I mean, Parramatta, which is where the Greater Sydney office is, and I acknowledge my fellow Commissioner for the Western District, Liz Dibbs, who's somewhere here, that is transforming before our very eyes. And what I find really exciting is that places like Parramatta will become like inner city areas in the next 20 years. That's how I see, you know, Sydney's polycentricity finally coming true.
I've got to ask you guys all about negative gearing. I mean, it's round the corner maybe, right? And interestingly, Louise, you don't. It's not going to be all curtains. If
I'm
there's
looking at
negative
Mr.
gearing.
Steinert out there on the Stockland table. No, as Mark has said, if you take the Labor policy that they're talking about in terms of negative gearing and in terms of not applying it to new product, then for someone like a Stockland, we're the largest residential developer in the country, building new or selling land, that's a good thing. That means there'll be even greater demand for our product. Then when you look across what we do, about 50% of what we sell are first home buyers, and it falls into different age stages as well. So we think, you know, it can be a positive, certainly for the residential new market.
Kylie?
I just think that as a policy issue, a lot of thought needs to be put around the timing of it, the implementation. It's quite a substantial structural change for the market to absorb.
Even with Labor's proposals around grandfathering?
Yeah, because it will definitely change the way real estate trades in this market on a go-forward basis. So we need to be careful when it's implemented, subject to other forces at play in the marketplace. So the policy around that is one thing. The implementation, I think, needs to be thought through very thoroughly.
You think this is not ideal given where we are in the residential property cycle?
I don't think it would be great if it was introduced tomorrow, given headwinds currently in the marketplace.
Yeah. Do you think?
But it will be,
do you think this will
if there's enough talk and notice, and it's the slow implementation, and when maybe there's a little bit more tolerance in the marketplace.
Yeah, but we're going the other way at the moment, aren't we?
I think we don't know what the timing is. We'll see.
Right. Okay. Lucy, do you have a view on this?
Well, can I just make an observation, is the one asset class which does not exist in Australia is institutionally owned build-to-rent housing. Now, that is something which I think is somewhat unfortunate, because I think, you know, if people can actually build entire, you know, rental housing like they do in New York.
Limited enthusiasm for it. Is that about getting more incentives to do?
Well, it's probably about yield and who the people providing the investment housing is. I think might have a bit to do with it. But I think if you could create a framework which supported the establishment of a build-to-rent investment class, institutionally and professionally held, I think that wouldn't be a bad thing. I'm not sure how you get there, but I just think it's a deficiency in our system.
Well, let's take that big property panel. 400 people were there listening. One of them actually was Ben Wilmot at the Australian's Commercial. He's the Australian's Commercial Property Editor, and he joins me now. So, Ben, a bit to come out of that for you? It was quite a big discussion with them.
I thought it was very broad, and I thought they were pretty guarded about where the residential market's going.
Well, actually guarded, you thought? Because, I mean, one or two of them, they were just saying that,
I think they were worried about a number of influences, but I think on the ground it's perhaps even worse than what we heard today. Certainly the auction clearance rates have been very low, and the new figures out today from CoreLogic have been some of the worst we've seen so far. Yeah,
so Lendlease was there and Stockland on the panel. Now, both of them have exposures to the residential market, don't they?
Both of them have residential exposure, both quite different and both really, in a funny way, best of breed. Stockland very good at master plan communities, on the estates on the outskirts of major cities and around the country. They perform very strongly, and they have been hitting their earnings targets this year. The worry is where we'll be in 2 or 3 years' time. Okay.
Now, on the other hand, they were very happy with the state of the commercial market, and I'm sort of thinking it's been going gangbusters for such a long time. Can it keep going?
Look, that is a question that's increasingly been asked. A lot of the more recent campaigns for major assets have got a bit thin because the prices have been very, very high.
Yeah. Rents have been very high.
There's also questions as well about that. Melbourne has been particularly strong, Sydney has been particularly strong, and they did note today that there was technology tenants coming into the market, which is true, but you do wonder just how many of these tenants there possibly can be.
Yeah. Especially as they're building more.
Each of these new towers, these commercial towers that all the developers have undertaken, have been matched by another new tower. Yeah. So that does actually mean there's a lot of supply coming.
And actually, one thing we didn't talk about, really touch on, really, was the apartment market, which is the reverse, isn't it?
Well, the apartment market, it's really cratering at the moment. And I think on stage today we saw, again, some of the best operators in Australia. What we're not seeing very much of yet is the second tier, the third tier operators, and where they're at. We're aware of a number of sites where people have simply stopped selling and have packed up and effectively gone home.
I think there was one story where they were just fleecing the whole of the apartments and redesigning it as an office the other day.
There's a lot of those examples in Brisbane. It's a factor in Melbourne now, and also in Sydney. So we're seeing it right along the eastern seaboard.
Okay. Urban renewal. Another issue that I thought was quite interesting was, and all of them, including Lucy Turnbull, talked about this, which is there's sort of whether there's a political backlash or how that's a public backlash to the density now in some of these big projects.
It's interesting. They are doing some of the best projects in the world, that is in Sydney, and they're comparable, as Lucy Turnbull pointed out, to what's been done in New York, and certainly in the case of Lendlease.
Like Hudson Yards. Exactly. We had the planner on the other day.
And they're also doing great projects in London, in the case of Lendlease. The problem is getting, I suppose, the populace on board with what they're doing. I don't think they're quite there yet. I think it probably needs to be more broad-based and more inclusive to bring the community along with them. Certainly the politicians aren't.
Some of them, like Fisherman's Bend, that development down in Melbourne, didn't that actually have to take a step back and not be so dense?
Yes, and so I think that's in response to community pressure. And in New South Wales, we're seeing exactly the same thing as the election approaches.
Yeah, negative gearing.
Look, it's a tough one. I think the panel was fairly wary about where that might go, particularly given the state of the market. I thought it was interesting that
Kylie Ramper.
She did call that out as something that you'd have to consider.
She wasn't happy, because there was Stockland, to say, well, Louise Mason, they're saying no, she's happy because they're into new homes. It was sort of encouraging. But Kylie Ramper, she wasn't so happy, especially on the timing of it, just as we're heading.
Yeah, and I think that's the most important point. Whatever the merits or otherwise of the policy, I think you've got to look at within a matrix where we're coming out of Royal Commission, a tougher credit environment, a higher tax environment, certainly for foreign investors, and stamp duty environment. All these negatives don't bode well for the introduction of a major change to a vulnerable market. Perhaps at a different time, I thought was the message.
Okay, really interesting lunch, I thought. Dan Wilmot, thank you for coming in and helping with it.
Thank you.
Terrific. Okay, well, after the break, more, we'll head off to politics, I think, next.
Now, back to Ticky.
Welcome back. Well, let's catch up with Canberra now. Malcolm Turnbull has hit back at Scott Morrison after the Prime Minister accused his predecessor of going beyond his brief on his recent trip to Bali. Scott Morrison says Mr Turnbull won't be sent to further international events on the government's behalf after he spoke out on the Israel embassy move.
The decision to send Malcolm Turnbull to represent Australia in Bali was always a contentious one. Some in the Liberal Party ranks were concerned he wouldn't help calm tensions over the government's announcement to review the location of Australia's embassy in Israel.
The President expressed to me, as he has done to Prime Minister Morrison, the very serious concern.
Then came this rebuke.
The issues of trade and other things were not really part of the brief.
Malcolm Turnbull took to Twitter saying, "A few facts. Scott Morrison asked me to discuss trade and the embassy issue in Bali, and we had a call before I left to confirm his messages, which I duly relayed to President Joko Widodo. There was a detailed paper on the issue in my official brief as well." But it didn't end there, the Prime Minister then tweeting, "So my previous tweet, a simple statement of fact, has been described in the media as lashing out, the Oz, or as a public rebuke, the Sydney Morning Herald. Neither characterisation is reasonable, but is objective reporting unadorned by sensationalism, a thing of the past." As for the future, the Prime Minister says his predecessor won't be representing him again anytime soon.
Will there be more missions for this man to be able to go to and sprout his own discredited views?
No.
But he's since agreed with Mr Turnbull, saying in a statement, as head of delegation, he was briefed on appropriate responses on other issues that could be raised in any direct discussions with the President in his role as head of delegation. Accordingly, there were briefings dealing with the issues he's referred to. The increasingly public stoush comes at a time when the government is trying to address another issue in the Pacific. Sky News understands as many as 70 children have already been removed from Nauru under Prime Minister Scott Morrison, with the aim to transfer the remaining 40 to Australia by the end of the year.
But we haven't had a briefing as to what the government has leaked to the media today in respect of getting all the children off by the end of the year. It's time for the government to come clean.
Our predecessors, though, are turning up at the rate of thousands every single month. The number of children on detention now is less than 40. Some weeks ago, and some months ago, that figure was over 100.
But the government's reiterated it's not a pathway to a permanent position.
So we've been getting about this quietly. We haven't been showboating about it. We've been doing it consistent with our policies. There's been no change to our policies whatsoever.
Annalise Nielsen, Sky News, Canberra.
And the Prime Minister has slammed the leaking of documents containing allegations against one of Australia's most decorated soldiers, Ben Roberts-Smith. Fairfax Media alleges the Victoria Cross winner was involved in 6 unlawful killings in Afghanistan, a claim Mr Roberts-Smith describes as bewildering and falsified. In his first public comments on the allegations, Scott Morrison says the leaking of Defence Department documents against Ben Roberts-Smith is deeply disappointing.
Well, those who are responsible for that, I mean, they're just not showing any of the values that Ben Roberts...
Well, my understanding is that leaking has occurred from within the Defence Department.
Well, you know Canberra. You know the Canberra bubble too, Alan. And those things deeply disappoint me when these things happen. I mean, there are processes for dealing with serious issues, but they're not processes that should be run in newspapers. Everyone should be treated with respect, particularly those who have served our country.
Alan Jones, the Prime Minister there. Now, look, that's all for the show tonight. Tomorrow night, billionaire industrialist Sanjeev Gupta. See you at 5 p.m. tomorrow night on Your Money, or tonight on Catch Up at 8 p.m. on Foxtel's Channel 604. Thanks for your company.